Scott Lee with Revesco Properties Trust is here today to tell us how his team evaluates risk and how they look at the fundamentals and make acquisitions when it's the most opportune time. My name is Cynthia Aasen, and I'm here with my business associate, Danielle Kinsey. We are dealing representatives with Parvis Investments. Our role is really to ask questions that investors care about, help them understand the investment, and really separate the fundamentals from the headlines. This is not an endorsement, and we are only here to help our investors understand the investment that they're about to make and to make informed decisions. Please refer to offering memorandum for any before making any investment decision. So Scott, you and I both know that investors don't invest in headlines, but headlines absolutely affect their behavior. So let's start where investors' mindset is today.
Well, I think when investors read the headline, everybody starts painting the entire marketplace with the same brush. And I think in order to really get a good picture or handle what's going on, you have to dive in a lot more specifically. So for example, it's a lot of overextended developers who are in heavily dense markets like, say, Vancouver, Toronto, Montreal, that are unfortunately stuck with excess inventory. They just can't move at this point. But that's just one small sector of the real estate market. It's not the entire asset class, and it's not the sandbox that Revesco plays in.
Scott, you've invested through multiple cycles. And when you look today at where the actual pain is, how do you separate the fundamentals and the pain in the asset class you're in?
Well, I think today it's a very challenging market, as we've all seen, especially locally. But if I look broadly and overall, I think residential and office certainly have their challenges. But where we find ourselves with the most opportunity is in retail, just primarily because of the fundamentals of what's happening in that marketplace.
So contrast Revesco's sandbox. How different is the US open air retail from the struggling Canadian real estate market?
Well, we look at what we focus on, which is open air retail, primarily shopping centers that focus on daily needs like grocery and pharmacy. The other thing we do is we also focus on markets with really high tenant demand and very low new supply. And so the combination of those two factors allows us to really focus on what we need to do, which is find shopping centers that deliver income day one.
Okay. Yeah, that makes sense. And not all assets are created equal, even in your space. So what would be those key value opportunities that you've identified that you're looking for in your acquisition process?
Well, we're looking for shopping centers that have a lot of opportunities in rental growth, because at the end of the day, our primary job is to create value for the investor. So we look for opportunities where they're well-anchored shopping centers that are really well-positioned, that have tremendous opportunities for rental growth. So
Right.
that's perhaps shopping centers that are mismanaged or have vacancy opportunities, or have opportunities where we can bring the rents from, say, a low level to a much higher level because of where they're positioned.
Right. That makes sense. Scott, I'd like to expand on Revesco's team, the depth, the expertise, and what really has allowed you to identify those opportunities in open air. I think that needs to be said.
Sure. Myself and my business partner, Chris Wood, have been in the retail real estate industry for over 30 years. We've represented every major retailer throughout Canada. Most of them have come from the United States. And as a consequence, we have these deep relationships with US-based retailers. For example, we've done over a couple hundred deals with TJX, which is Winners, Marshalls, HomeSense. We've done Chapters, Indigo, Cineplex, Odeon, Apple, on and on and on. So those are the types of retailers we work with. In addition to those types of players, we brought Nordstrom into Canada. We brought Target into Canada. We worked with Lowe's. We brought many other large format anchor tenants, in addition to the people like Costco as well. That's kind of forms the basis for our relationships and our knowledge base. So with Revesco Properties Trust, we have the ability to call on those relationships when we're looking at assets in the United States.
Right.
So as a consequence, we can get intel or get opportunities brought to us that perhaps others may not be able to. And that's where the magic really starts to happen. Because at the end of the day, your sponsor is looking to create value, but also reduce risk. And the best ways to reduce risk is to have that insight from the retailer. And it's not just somebody on the periphery. Like, the end of the day, like for example, I was in conversations with the senior VP of real estate for Whole Foods, Amazon worldwide. A lot of other people could call Amazon every day for the rest of their lives and never get a phone call back. We have the ability to speak to certain folks at a very high level to at least get a very good understanding of what's happening in any particular trade area or market. And that's kind of part of Revesco Properties' secret sauce, if you will. On top of that, we have an office here in Vancouver, but our entire operational head office is actually in Denver. The main reason is we want to be seen as buying assets as a local investor, not a group from Canada trying to parachute in and try to buy something in the States.
Right. So what do you think that sophisticated investors misunderstand your product? What is the common, when you explain your investment, what's the feedback you're getting from investors, and what don't they understand? Because really that's the point of the conversation today, is to help people understand the value and why they should invest with Revesco.
That's a great question. I think there are probably two main areas of kind of misunderstanding. Number one is what's happening here is happening everywhere, and that's clearly not the case. You have to remember, Cynthia, that our sandbox is in the US open air retail shopping center world. But honestly, there's no one else in Canada doing it today. I think the other big concern that has gone through people's minds over the last several years is online retail and the impact it potentially has on retail stores, bricks and mortar. The reality is online retail and bricks and mortar have to work together. The world's best retailers, and we have two examples here in Vancouver. We've got Lululemon and Aritzia. They do phenomenal jobs on combining both bricks and mortar stores and online retailing. I think that's the best example of what we see going forward. And those are the types of shopping centers and retailers that we want to have in our portfolio.
I concur. I mean, I like to buy clothing, but I want to feel it. I want to touch it. I want to try it on. And I think that's a great compliment. Yeah, good point. So if investors ignored everything else and watched just one or two metrics in the US retail right now, what should they be?
That's a great question. The two areas that I would have investors focus on would be very basically laws of supply and demand for commercial real estate, in particular commercial retail real estate. And what we've seen is a dramatic decrease of supply over the last several years, primarily because retailers are just getting more efficient, and there's just been a lot more mixed use development or conversion of old malls into residential. The other area to focus on is the US consumer, and that's something we pay a lot of attention to. The US consumer is still 65 to 70% of the US GDP. So they're extremely important in the overall analysis. But what's interesting about the US consumer is they can move up market, say buying luxury goods and what have you on a day-to-day basis, but they can move down market very quickly into buying daily needs, everyday goods and services. And quite honestly, that's where we focus most of our time anyways when we're acquiring shopping centers. We're not looking to buy luxury-based malls. Our opportunity really is in the kind of the value, the grocery anchored or the everyday goods and services anchored shopping centers. That's where we focus our time and effort, and that's where the value is going to be created, whether it's in good times or in bad times.
Right. So recession proof.
Exactly.
Great. So let's just shift more into what kind of investor is Revesco looking for?
Well, Revesco is looking for an investor that is looking to create long-term wealth. Really, that's at the end of the day, that's what we're as sponsors, as leaders of Revesco Properties Trust. Keep in mind, we have over 10% of the equity in the fund. So our goals are aligned completely with the investor. So we're looking for income, but mainly wealth generation, if you will, long-term wealth creation. So typically, our investor or our shopping center investments, I should say, typically take about 48 to 51 months to go full cycle. While Revesco Properties Trust is a young fund, our principals are extremely experienced. We've all been in the industry for over 30 years. We've seen more cycles than we care to count. We've sat in front of lenders in 2008. I've had to negotiate with anchor tenants during COVID and remind them, hey, you still have to pay your rent. So we've seen everything, and I think that allows us to move the value of these shopping centers up over kind of that time frame.
So before an investor commits capital, what should they be committed to? Are you saying 3, 5, 7 years? What is sort of the ideal time frame?
So That's a great question. So typically, we've started the fund in 2021. So we're roughly 3.5, 4 years into this process. We'll start seeing over the next kind of year, year and a half, 2 years, opportunities to roll out of some assets, take advantage of some of that value creation, and then roll into new assets. So as an investor starts looking at Revesco Properties Trust, they're going to start seeing some of those value creation opportunities and start seeing that jump in value over time.
Scott, I want to shift gears and slightly, and I'm going to hand this off to Danielle. She's going to take us into the U.S. market context and dig in how investors should think about the political noise and versus real estate fundamentals.
Great, let's do it.
So we're going to shift south of the border, talk about the U.S. election years, bringing a lot of noise, volatility, rhetoric, that whole section. How do you separate the political headlines from what actually matters to investors?
Great question. I mean, Danielle, unfortunately, election years always feel chaotic.
Mm-hmm.
But the chaos in the headlines is not the same as the chaos in the fundamentals of real estate. If you look what's really happening down in the United States right now, we have the national retail vacancy rate at around 4%. We've had something like 11 straight quarters of rent growth.
Mm-hmm.
Job growth and consumer spending somehow still remain resilient despite all the chaos. And then what we're seeing is institutional equity now coming back into the U.S. shopping center market. So yes, there's noise out there, no doubt about it. Strong fundamentals in a noisy environment create opportunity, not risk. And that's why I think long-term real estate investors of retail real estate will always do well.
Yeah. Can't argue with vacancy rates.
Yes.
Okay. So strip away the politics and look at the data in the U.S. So you talked about vacancy, rent, tenant demand. What's the story in the U.S. retail market telling you today, in addition?
Well, we talked already about the long-term trends in terms of what's happening. We discussed that already. The supply of new retail real estate continues to fall, and the demand from the tenant side of the equation is still quite strong. What we're also seeing is I'm looking at where the smart money is going. That's the institutional equity, and they're coming into the shopping center genre of real estate. They've been there, done that with office. Multifamily is not where the growth is. Industrial is still fairly strong, but they're also, a lot of those institutions are overweight already. So retail is really the last kind of genre that they can really invest their funds into. And we're starting to see that now, which is a huge benefit for RPT investors because we are up and running, we are in that marketplace, and they're looking for great sponsors to either co-invest with or acquire our centers.
Right. Good place to be. So when we're looking again strictly at the data, we want to dive in and elaborate a bit more on the retail market and how that is in the U.S.
Sure. Well, the one thing about retail is the only constant thing about retail is change. So at that point in time, you really need to rely upon your sponsor to be able to help the investor sift through all the noise and understand what's happening in the trends, as well as what's happening with the retailers. And so, for example, most recently, there was a chain called Joann's Fabrics, had a number of locations throughout the United States that recently declared bankruptcy. There was a lot of concern. All of those locations got picked up by other retailers, showing just the demand side of the equation was very, very strong. And then you have these unintended consequences. Like, for example, Michael's Crafts, which up until recently, we were kind of concerned as a tenant long-term, but because of the demise of Joann's and some other similar retailers in that genre, Michael's has actually improved substantially, and their business outlook actually looks quite stable. So you do have these unintended consequences that can happen in retail, and that's why you need to rely on your sponsor to help you sift through all those changes.
Yeah, exactly, the experience there. And so strong fundamentals don't mean no risk. We all know that. What would need to change in the data for you to become more cautious with Revesco?
Well, we kind of talked about this earlier, which was the U.S. consumer and where they're under pressure, and what we look at are the trends and what they're spending their money on. And once we start seeing, for example, where they're spending, say, less on luxury items bought from, say, a Prada, Chanel, Gucci, they'll start looking at acquiring goods from, say, a Marshalls or a TJ Maxx or maybe a Ross. That's where we'll start to see some trends starting to indicate maybe a change in the consumer sentiment. But for us, because that's where we acquire most of our shopping centers, we're very comfortable in the shopping center marketplace that services daily needs and goods and services.
Well positioned.
Yeah.
Okay. So your U.S. consumers, we've mentioned, are really recession-proof. And so let's talk a bit more about that in detail.
Sure. I mean, keep in mind the U.S. consumer is roughly 65 to 67% of the GDP of the U.S. economy. So that number has to change, quite a bit in order for us to start getting really concerned about what's happening in the retail market. Having said that, the reality is even if the U.S. consumer comes under some stress, they're perhaps going to shift their buying patterns from, say, higher end, more luxury brand goods to more daily needs or things they need every day. The consumption is still going to occur, but it's perhaps going to occur in different areas of the marketplace.
One of the biggest differences between public and private real estate is liquidity. How should investors think about capital commitment when they look at a vehicle like Revesco?
That's a great question between private and public. The great news about public real estate investments is they're extremely liquid, but the bad news is they're also extremely liquid. A lot of times, or there are moments in time where emotionality kind of kicks in for the average retail investor, and so there may be a situation where they feel like they have to sell, and that may or may not coincide with either the real estate cycle or, more importantly, the asset management plan for the individual assets within the portfolio. So at Revesco Properties Trust, we have individual asset management plans for every single asset. And on average, it takes kind of 3 to 4 years to kind of execute those management plans. And then once we hit that point, that asset is put up for sale and disposed of at the appropriate time because it's the right thing to do for that asset.
So we're going to move on, talk about leverage.
Mm-hmm.
You use that, but conservatively. So we'll walk through what risks remain when you're looking at fixed rate debt and moderate loan to value.
Yes, I mean, we use fixed rate debt because we are conservative by nature. We have 10% of the equity in the fund between ourselves and our partners. So we are fully aligned with you and your investors. The reason why we use fixed rate debt is so that, quite honestly, we can sleep at night. We don't have to worry about the ups and downs of the mortgage rates. We can simply focus on our business and execute on the management plan. The risk is that maybe we leave a few dollars on the table because interest rates have come off. But as we see the next several years, at least for the foreseeable future, interest rates will probably remain relatively steady. They may dip a little bit, but not dramatically. So that just allows us and our investors to sleep well at night and allow us to execute on the management plan to create that long-term wealth generation that we're supposed to do.
In a conservative way.
Right.
It's important for investors to diversify. And with all the knowledge that Revesco has, it might be a question you get a lot. Why is it that you're investing in the States and not in Canada?
Yeah, I mean, part of the reason why we invest in the United States is just geographic diversification. We want exposure to other markets. The other thing that we realize that in Canada, there are so very few shopping centers available for sale at any given time. In speaking to one of our leading investment brokers in Canada, he told me last year there were roughly 20 shopping centers in all of Canada that were grocery anchored that traded. If you are an institutional investor or even a large private investor, if there's only 20 trading in the entire country, the reality is there's not enough scale and opportunity to find those risk-adjusted returns that we are looking for as well as our investors. That's the reason that's why we looked at the United States. It's 10 times larger than Canada, and so as a consequence, it's just got a lot more opportunities to find those great value add situations.
If investors take away key highlights from this conversation and apply it to their Monday morning, what should it be? Let's talk through your why and your how.
Sure. I mean, at the end of the day, we talked about it earlier, geographic diversification and trying to find those risk-adjusted returns. Revesco Properties is in a unique situation because we have the relationships, we have the experience, and we have the local presence in the United States to be able to find those opportunities. So that's number one in our minds. Number two, it's really, as a Canadian, we've created a vehicle that makes it easy for the Canadian retail investor to invest, to provide that steady income along with the long-term wealth generation that we're looking to create for our investors.
Right. So they can invest in registered funds, LIRA, RSP, TFSA, and then move that into their RIF, take it as income or reinvest as DRIP.
Absolutely.
Different options there.
it's really set up to handle investors' requirements over a long period of time, depending on how their life evolves.
Okay, Scott, so thank you so much for walking us through how you separate what's loud from what's actually important to the investor and what matters. For investors watching this, if today's conversation raised questions about fit, structure, or how something like this might work in your portfolio, I would encourage you to reach out to the Invest Differently team, myself, Danielle, and Cynthia, and we're happy to walk you through all the details. Thank you, Scott.
Thanks, Danielle.
Thank you.